All right. Hello, everybody. We apologize for the technical glitch we had with Microsoft Teams. So Jim and I are going to have a conversation here. I did have some questions prepared for him, so hopefully you'll enjoy that. As a bit of quick background, Dr. James Thorne is our chief market strategist here at Wellington Altus Private Wealth. He has a PhD in economics, originally actually from Scarborough, Ontario, of all places. So we'll give him a thumbs up for that. And he is has extensive experience working, both for Canadian and U.S.-based financial institutions, providing market insight and investment strategy. He is a frequent contributor to financial media and is often seen on BNN, Fox Business, amongst other financial channels. So why don't we get right into our conversation here? So Jim, I'm going to start off just by asking. We know markets, had a bit of a bumpy start to the year and then got onto a good footing into February 16th. And then the wheels fell off. What happened? Like in your view, what happened? Why did it happen? And where are we at right now?
Well, Conrad, every year we should expect an 8 to 10% correction. And, the excuse can be for whatever reason, right? And so, when we talk, we say, okay, every year we're going to have a correction. It's going to keep the newsletter writers in business because they'll say it's the end of the world, right? And so, we're coming into this year, I think what we had a very strong rally off the October 22 low. We had a nice, strong bull market, and President Trump had gotten in. The market had gotten a little bit tired. And so we were expecting a correction sometime between March and May, actually, but nothing out of the ordinary, 8 to 10% correction. I think the thing that surprised me the most was the Liberation Day and what happened at the Rose Garden and how the stock market interpreted President Trump's negotiation strategy, which is fully documented in his book, Art of the Deal, and continued to proceeded to think that the end of the world was nigh. And, typically, what President Trump said in his book was, if you're going to go into a negotiation, A, you want uncertainty, and B, you want a low ball if you're trying to buy somebody, right? Or highball. You want to come on in your first foray is an unreasonable offer. And, that's what happened in the Rose Garden. The Wall Street and the mainstream media took it literally, and there you had it. You had another drawdown where we had what should have been just an 8 to 10% correction morphed into a 18 to 20% correction. And we were talking throughout this, buy, because this was a wonderful opportunity to position yourself in companies that are ready to go in terms of where we think the economy is going to grow and how it's going to evolve into the end of the decade.
Right. Now, I see when I look at your work here, you've maintained and did maintain through the entire correction your target for the S&P 500, which is 7,000. And we've seen a lot of other market strategists, Wall Street banks, et cetera, vary their targets, bring them down. Some banks, which will remain nameless, moving their target on almost a bi-weekly basis. You're sticking with that 7,000 call, which is about 20% higher from your. What's the driver for that?
Well, first, I grew up and I spent my time on the buy side, which meant, when I made decisions or I was a CIO, typically what would happen would be we would make these calls for, a year, right? Because what we're doing is we're building portfolios. And if we were going to make an asset allocation change, given unusual circumstances, we would typically adjust our yearly view after the second quarter or halfway through the year, which is what we talked about when this was going on in April. We said, let's just be calm. Let's evaluate the data. We know he wants uncertainty and chaos. And let's evaluate what's going on at the end of the second quarter as we get more data. And so the thesis had always been economy slowing, money supply is going to increase, liquidity is going to increase, and in that type of environment, secular growth names or companies that can grow their businesses irrespective of what's happening in the cyclical nature of the economy will do very well. So why did I go with 7,000? Is because we're going through one of the largest innovation periods of our lifetime, which is AI, where our economy is supercharged in terms of at least the United States. I don't know what the heck's going on in Canada, but that's for another day. We're evolving into a digital economy, and there's going to be a massive amount of capital spent because folks understand that it's a winner take most environment where if you don't innovate, you cease to exist as a company. So I was in the position of saying monetary supply is going to increase. Earnings in these companies that are tied to AI are going to grow. It's going to be massive amounts of capital expenditure. And therefore, I would sit there and I think 7,000 is where we should end up. And I still feel that's where we are today.
Right. So again, there's a lot of narrative out there around. Let's look at it from the other way. We understand what, in your view, is propelling the market up. Where are the bears making the mistake? And what I mean by bears there is just where are the strategists that would say have a negative price target on the market at this point? Where are they making where's, in your eyes, where's the critical mistake being made?
Well, first off, I don't think when you look at it, I just don't think the tariff event is that big. And let me explain. Only 14 8, let's just make a general number. 75% of the US economy is service-based. 10% is manufacturing. 14% of GDP is imports, and 1.5% are direct imports from China. It's just not that big of a deal. It's not, and tariffs aren't inflationary. They do slow growth. So these people that were calling for a recession, I feel they missed the boat in the sense that we were calling for a growth scare because, Conrad, my reference point was post-World War II. We have an economy that was hooked on government spending, debt to GDP 125%. Now, as we shift to an economy and we go through this detox period where the economy now gets re-engaged and is driven by the private sector, we typically have a growth scare. And that's where our call was coming into the year. So where I differed from everybody was, first off, with Trump and the Rose Garden scenario, nothing had happened. It was just a PowerPoint presentation or a Bristol board. Nothing had been kicked in. And you had these people that were very emotional. And as I kept going through this, I go, remember these people that are very, very emotional. This is what Wall Street does. So I was just looking at the facts and sitting there going, okay, so if we take 10% of 14 and apply it to CPI, what is it? And you sit there and go, it's like 50 basis points of a one-time hit. Well, that's counteracted by, oil trading somewhere between, 55 and 60 and gasoline at the pump going down. So to me, it was a lot of much to do about nothing. Great narrative. Had a lot of people go on TV and yap about it. But the other thing where I was different is, and this goes to what's happening with President Trump in the Middle East. I mean, he's already closed $2 billion worth of deals. The void that was left by China and all this, national security has been filled. Right? It's been filled. So what I was suggesting throughout this is the big theme is AI. I lived through this in the 90s when we had the Asian contagion. And what did we do? We sold all of the internet and the telecommunication stocks. We sold all the A's stocks. And then after the crisis had gone away, we all flew back into them. So to me, nothing has changed. We're going to the end of the decade. President Trump knows what he's doing, and buy high quality stocks that are tied to AI. Simply speaking.
Right. So that's appreciate that perspective there, Jim. Now, one of the things that I want to talk to you here about is one of the like in doing we've as this volatility has unfolded, we've moved to doing a weekly or biweekly video depending on the sort of the news flow, and because of that, we're very attuned to what questions are being asked. Both in general and also specifically because we want to address that in our video content. Now, one of the questions that continually comes up, and this is, whether we feature it in our videos or not, is talking about the link between tariffs and inflation, because there's a very powerful narrative there. And could you maybe give us your perspectives on that, about, your view on how inflationary are tariffs, if they're inflationary at all?
So a one-time price increase is not inflationary. It's not the definition of inflation. We were back in undergrad, we would be asked the question is if our tariffs inflationary? Well, let me rephrase the question. Is the GST inflationary? Is a sales tax inflationary? And the answer is no. And if you look at tariffs as a consumption tax that's just placed where the goods are coming into the country, you reframe the argument or the narrative. But let me just get into the weeds. What if you take 14% of US GDP and you just apply a tax of 10% or a tariff of 10% on those goods, you change the relative price structure of the economy. And unless consumers have more money, what they will do is they will adjust their consumption patterns accordingly. And typically what that means is a slowing of growth. So that's fact. Go back to Trump 1.0. His first round of tariffs were not inflationary. So I don't know where Wall Street gets this. I don't know where the pundits get this. But what I continue to say is that if you are investing with a company or an individual that thinks tariffs are inflationary, then you need to revisit the reason why you're dealing with that individual. Because this is basic economics 201, not even 301.
Right. Well, and there's also the argument as well that you put forth that it's, the tariff doesn't exist it's not a closed system tariff and consumption. There's also gasoline, right? There's other factors that can drive or decrease inflation. So it's a complex system. And again, there's a lot of variables that in this case definitely reduce the impact if it exists at all, as you point out. Now, another thing we want to talk about here is, where we do see, again, a lot of questions around is really defining like what is the Trump agenda, because a lot of folks really get an unsettled feeling because they see a lot of what they would term as, or gets labeled as chaos. Again, my job is not to label anything that, is happening south of the border as any which way. We just want to deal in facts. But, that's a frame that's very often used when we're looking at, the media. And media sources is sort of it's a chaos and there's no plan. What is the agenda? Like, what are they driving at the end of the day? Where are they trying to take the car? Whether they're successful or not, that's not the question. But like, where are they trying to get to?
The growth path that the United States was on after World War II and the growth path of the global economy after World War II was unsustainable. And Keynes made a prophecy in 1944, Bretton Woods, about that. The United States was living beyond its means, and it had to change. When interest on debt got larger than expenditure on military, the United States had basically entered a very unique realm in terms of empires that no empire has been able to survive this type of fiscal irresponsibility. And that's what Keynes was talking about in Bretton Woods. He was warning the Americans that you're going to follow the path of the Dutch, the Romans, the British, everybody. Okay. So when you look at it that way, and what's interesting, Conrad, is that Secretary Besant, the Secretary of the Treasury, taught history of economic thought at Yale. He knows this. So we can all hate Trump, but look, we have an unbalanced global economy. You want to blame somebody, blame the World Bank, blame IMF, blame the World Trade Organization, and blame GATT, because those were the mechanisms put in place in the institutions to ensure that the global economy would be balanced. And it is completely unbalanced. So America had to change. Trump has understood this. And if you go back to listen to his interviews back in the late 80s, his narrative has been consistent, right? And so he has been saying we cannot be the policeman of the world. It costs too much money, right? Why isn't Japan paying us money to defend them? He said that on Oprah in 1989, right? So none of this is new. I know the mainstream media doesn't want to cover it, but as you touched on before, we're just trying to be objective researchers. So what is he doing? Look, manufacturing in the United States is 10% of GDP. All he's really trying to do is onshore critical supply chains. He's learned the lesson from COVID, which Canada should, which we all should. Okay? So you can get mad at him for that. Okay? The rest of it, Conrad, I'm going to say is that it's a very interesting argument, because living in the States as long as I have and having kids that are dual, I've taken civics course or helped them study for civics courses, right? And look, the power of the purse does not reside with the president of the United States, right? Bills, right? Taxes, tariffs are according to the Constitution, is the House of Representatives and the Senate, right? So what he's doing is, one could argue, is unconstitutional, but he's using the realm of national security to do it. So there's some areas where he could do it. Protecting Wisconsin cheese or going after Quebec cheese and dairy, I don't think is a matter of national security. Protecting Hollywood movies is not a matter of national security. So there's some scale and scope here that he may have overreached. And that's why, Conrad, I come up with my narrative is, look, he's got to codify these executive orders. And to do that, he needs to get a big majority in the midterm elections. And you and I have talked about this a lot, about the 4-year election cycle. And yes, we know that 2026 is a midterm election cycle, a year. And we know that typically the economy slows in the midterm year and the stock markets have that big correction that we had in April. Could it be that President Trump is trying to front end load the chaos so that he can get the economy going great and the stock market going great, gasoline at the pump at $2 for the midterm elections, so that then when he has these big majorities in the Congress and the Senate, he can take his policy, his Trump doctrine, and move it from a very temporary executive order realm to law. And I think that's what he's trying to do, right? And so to me, it's also what he is also doing is he's stepping back. We're moving from a unipolar world, whereas it's the United States, to a multipolar world. Just watch President Trump's speech in Riyadh, right? Look at what he said to the Saudis in terms of what they have done to build their economy, keep their culture. The United States is pulling back. And President Trump is willing to cede the evolution of the Middle East to the folks that live in that area. That's a multipolar world. He's trying to get a peace dividend in Ukraine. He's going to sign a grand bargain with China. And the United States is going to pull back and focus on themselves. I think it's much more it's as simple as when you watch the videos of the Trump motorcade driving through the streets of these global cities in the Middle East, and how gorgeous and pristine they are, and how the infrastructure looks so great. And then, I don't know, pan it back to downtown Calgary or downtown Toronto or San Francisco or LA. They're dumps. They're dumps. We've got to rebuild. We've got to focus on our own. And that means Canada as well. And I think that's really what the Trump doctrine is.
Right. So it's get some reshoring of some, higher paying jobs, earn a peace dividend by pulling back from being the world's policeman, and rebalance global trade to be on, basically rebalance global trade between consumptions and consumers and savers.
Yes, and if he takes the page out of book of Alexander Hamilton, which is the 10% tariff, remember the Americans had no income tax coming out of the Revolutionary War, and Hamilton put in a 10% tariff, and it was high enough to give a little bit of protection to U.S. industries, but it was low enough to keep international trade coming in and out of the United States. Why? Because it generated revenue for the economy, for the government. So I think what we're going to do is we're going to go back to a 10, he said we're going to go to a 10% flat tax or a flat tariff across the board, which means they're going to get maybe 300 to 400 billion in revenue a year. You'll get that 1%, that change. So it'll be on wholesale. So the Nike shoe that was made for $20 in China, wholesale, now it's coming into the United States at $22. And then so what are the, you might see a de minimis raise in your $275 Nike shoe, right?
Right. So it's, and I think that goes back to, again, the earlier point about the tariff is you made there about not being non-inflationary, is when it's always done at wholesale, and there's such, especially on some of these iconic brands, the markups are extreme from wholesale to retail. That does diminish the impact of that as well. Moving on to Canada. I know you've talked a little bit about Canada. We've recently, everyone knows, and it's always top of mind out here in Alberta about recent elections and cabinet appointments. What's your read so far on Mark Carney, and what, at this point, again, we know that this is always subject to change, new information leads to new outcomes, but at this point, where do you see the path forward here, the most likely path forward here with Prime Minister Carney?
Well, first, he's a smart guy, right? And as I've said on many podcasts and TV, I was living in Washington, D.C. When the global financial crisis hit. The firm I worked for, the bank I worked for in the States, we were the only bank that had no exposure. I can't amplify enough how scary it was, even though we didn't have any exposure. The system was about to blow. And the calming factor, the guy that held things together, was Mark Carney. It wasn't Ben Bernanke. And what I say is, Ben Bernanke got the Nobel Prize in economics for that. Carney should have got half of it. So he is a very, very capable man. Okay. And he's a central banker. So let me just put that. And he got his PhD from Oxford, really smart guy. But I want to focus on the other side of his career, which was, after Harvard, he went and worked for Goldman Sachs. And was the chairman of Brookfield, right? So he has Wall Street experience, which we tend to ignore. Okay. And so, so where do we go from here? And the way I look at it and the way I listen to what he has to say. And so let's just be clear about that, right? I mean, his net zero program has been abandoned by the global financial markets. Okay. He knows it. He sees it. Okay. Just because he advised Prime Minister Trudeau, an advisor is completely different than the person that's sitting in the seat. Okay. The other thing I would say to you is in Canada, which is, I think, not unique, but I find interesting coming back home, is the power that the PMO office wields. So I really discount what his cabinet looks like. He doesn't even have a finance minister. All right. So let's get the brass tacks. All right. And let's be honest with ourselves. Is Canada going to become a hard power in energy or not? Is Canada going to embrace its natural resources or not? When you and I talk, Conrad, that's the question. Because if Carney continues to implement 4 more years of Trudeau policy, then the Canadian dollar is going to 60 cents. And Canadian investors have way too much exposure to this country. Right? To me, he really doesn't have a choice. Right? He's got to make a deal with that. I'm going to be blunt, and then I'm talking to Alberta. He has to make a deal with Alberta. Right? And Danielle Smith knows this. Danielle Smith has a trump card, President Trump. Right?
Mm-hmm.
Carney will make a deal. Now here's where I differ. And I'm going to go share some, it's funny, I talk about this. Things happen in my life or your life, and you never know when you're going to use them. So I was in graduate school, and I used to play a lot of bridge in graduate school. And we had a friend who liked to play bridge, and her father was coming to town. And he happened to be this guy named Ron Enders. And Ron Enders was the U.S. ambassador to Canada. And we were playing bridge with my buddy, Jim Whiteman. And he looked at us and said, this is when Mulroney and Reagan were negotiating. And remember, Canada was a branch plant economy at that point in time. And he said, the only reason why we're doing this deal is because we want a continental resource and energy plan. And it was, Conrad, it was called the proportionality clause. And in that clause, the United States had secure access to our natural resources, Alberta natural resources. And just to give you a sidebar on that, I was very fortunate to get a very prestigious scholarship, a summer scholarship, for the top Canadian energy company named Imperial Oil. Right, I worked in their finance department. Imperial Oil, I think, owned 73 to 75% by Exxon. Okay, so the Americans understand the tar sands, as I will call them. America wants safe oil and natural gas. It is, listen to the tapes, it is imperative to have that to win the AI war. Just listen to what was going on. Look at what Saudi Arabia is doing. What is weird about the whole process is that when Trump 1.0 negotiated the free trade agreement with the Trudeau government, the proportionality clause was not renegotiated. Right? So all of a sudden we became a free agent. Up until that last clause, we were not free. Well, we were free to the point where the United States had a fixed portion of our natural resources. And if we wanted to sell our portion elsewhere, that didn't affect the U.S. portion. So I don't know why that slipped through the cracks. I don't know who did it. Unintended consequences. But it's interesting. When I watched, and because there's a lot of inconsistency, when I watched the Premier of Quebec go back to his House of Commons and explain to the members of Parliament there in the provincial legislature what happened in Washington, the question was basically this: the Americans don't have aluminum smelters. They need our aluminum. We have the hydro. What is going on? Why are they doing this? And he came back and said, security. They don't feel that our supply source is secure. Hence the proportionality clause. So I think they're going to renegotiate. This is not about the supply management system, which is Quebec agriculture, right? This is not about the language law. Two areas that Trump said coming out of the Rose Garden that he was upset about. I think those are a joke. I think he wants Alberta's oil and natural gas. They need it. There's going to be cut a deal. Now, when you go back to C-69, he's already mentioned that he wants to do the Keystone. I come back and I say this to you. Can you guys pump? You guys arguably have the Permian is depleting. They've got to shift production to the Marcellus. They know underneath the nat gas there's liquid, right? There's wet and there's sweet. They need our oil. And so could you guys increase production to go from 4 to like 8 million a day, barrels a day? How many pipelines would it take? Because the Americans need it. The Americans want it. The Americans have the refining capacity that has not been upgraded, right? So when you hear people talk about a pipeline to the east or a pipeline to the west, I sit there and go, yeah, go ahead, knock yourself out. But when you have Saudi Arabia and Qatar and all these people wanting to cut deals with the United States, why isn't Canada? So we're making this way too difficult. And I'm taking a page out of the book of, the Council of Foreign Relations. I see us as becoming more economically integrated with the United States. Having said that, I think the profound, hard part, I'm from Eastern Canada. It's going to be the Eastern Canada, the politicians and the folks out east recognizing that Calgary and Alberta is really the seat of economic power in this country. And I don't know if the Laurentian elite have been able to come to grasp that. I think that's where we are, right? So when you look at, we were talking about this the other day, look at what happened in Riyadh. I mean, the head, NVIDIA, the head of Jensen said, it's not about the chips. It's not about the servers. It's about the AI industry. Cheap energy is the key. Calgary, Alberta could become a leader in AI. Right? So I feel like I'm in Pennsylvania in 2003 talking at the Nindy Lion Inn when the Marcellus was first discovered, right? Mm-hmm. And I worked for a Warren Buffett bank, and we were financing everything. And I'm going, guys, we're sitting on all this nat gas, and you're worried about whether EMC is going to go back up to $200, right? So when I look at what's going on with you guys, I look at the economic future of Alberta. You guys have no clue what's going to hit you. It's big. And this is about that. You want to talk about national security? This is it. The power shifts west.
Right. Well, I will share a thought that was shared by Jensen Huang, the CEO of NVIDIA. Basically, that sort of, for me, cemented understanding of what's going on here is that we're in a business now of manufacturing intelligence from electrons, right? Turning electricity into IQ points. It's an industrial process, and it's going to, it is, winning at energy is winning at AI. Now, I'm going to circle back to something that we talked about earlier in this conversation as we wrap up here, Jim, is that, again, as you mentioned, spent time as a chief investment officer in various roles. And you've also referenced several areas. You've used the word secular growth. What does that mean for you in terms of opportunity set? Like, what do you think is those, where do you see those secular growth opportunities right now? And if you were building a portfolio now, where would you be overweighting or underweighting?
So it's difficult because I'm top down, right? So what I would say,
just at a sector level, we don't need to get to specific names.
No, I think so. Just look at it. You need to own, and it's going to be different. So when we talk, look, valuation doesn't matter in this period of time, right? This is about figuring out what this thing looks like in 2035. Valuation, we don't know what the total addressable market is going to be. So you buy the leaders, the Teslas, the Palantirs, Microsoft, NVIDIA, AMD, Avago. You were buying, or Quanta, GE Verona, anything in power, Eaton. You sit there and you think about an infant industry that's about to grow. And that's where we are. Okay. And then you ask yourself the question, and then you get tactical, right? The tactical question for me is I think they're, energy. I like energy. I think, pipelines are great. I think nat gas is great. I think uranium is great. Copper, if you want to buy a little bit of copper, anything that builds this new industry that we takes our world from the analog to digital. And why is Alberta so important is because they got the energy to cheap energy to turn the electrons into information and intelligence, right? So that's what I would do. I think that, Trump is going to deregulate banks in the United States, right? I think they need, we didn't really talk about Trump and the deregulation phase, the private sector phase, tax cuts. He is going to allow the regulatory framework in banks in the United States to go back to pre-Dodd-Frank. Now, Canadian banks, until here's now stuff on the come line. With Canadian banks, their dividends are going to be safe, but they're very expensive. And given what happened with TD Bank, they're not going to be allowed to take their excess capital that they earn up here because of regulatory capture and go down to the United States and purchase other banks. How are they going to grow book, Conrad? And I would say to you that one of the things that Team Trump is going to go to Carney when they renegotiate is deregulating Canadian financial institutions so the Americans can come up here and compete. Reciprocity. Right. So so the non-consensus trade is more integration, not less. I don't see you guys leaving. I know, but you're at the line. I think Carney knows this, right? But then I ask you the question with Bill C-69, really, guys? What, a pipeline to Lake Superior or Churchill, Manitoba, or into Montreal? Really? That's what you guys are going? Can we think big, guys? Can we start to think really stinking big? Right? Stop thinking like Canadians and realize the opportunity that we have, because I see it evolving that way. I like the US over Canada, right? And why I feel this way is this feels to me the event in April was like the Asian contagion in the late 90s that scared everybody out of the thematic place. And then once the smoke cleared, then everybody went, oh my gosh, actually, AI is the place to be. And that's what you're seeing right now. So I know when you and I talk and how we work our way through this, that you agree with that type of a scenario.
Yes, we're quite allocated to names in that space. And I mean, really, it comes down to, as I always say, is follow the earnings growth, right? You can't, if you show me one index where the earnings growth is 6 and you show me another index where the earnings growth is 20, I'll tell you which one will outperform.
You would not, if you wanted, when you, and I don't know if you own this, so if you don't, I apologize. So I don't want to get you in trouble.
No, you won't.
But I look at a company like Palantir, and to me, it feels exact. I am old enough to remember opening up my 286 personal computer and having to use MS-DOS. I remember using my personal computer before Windows. And then Windows. So what was the big thing, right? Microsoft learned how to write in protected mode, which allowed us to have all these windows. Once that happened, Microsoft went through the roof and it was expensive, right? And it was a monopoly, right? What do you pay for a monopoly, right? That's what Palantir has done. I don't know what you pay for a monopoly, but you don't even have to go that far. With NVIDIA, this is where I get frustrated. NVIDIA is expensive. It's trading at 20 times. Costco's trading at 60 times, Conrad. Walmart is trading at 55 times. So can we be at least a little bit intelligent or consistent here? And so when I look at it that way, I know the theme is there. Demographics say we're in a secular bull market till the early part of next decade. But as we walked and started this conversation, Conrad, there are going to be these periods of time where we get significant drawdowns.
Mm-hmm.
Right?
Well, it seems to be the pattern that we're every 18 months we're getting a 20%er, which again I think does ultimately creates opportunity for those who are willing to, again, as Warren Buffett said, be greedy when others are fearful, and fearful when others are greedy. And I know every client who's on this video has heard me say this 1,000 times, and I will continue to say it because that is ultimately is a big value add, is to be able to buy when others are freaking out and being able to quell, as you have said before, Jim, quell your emotions.
Sure. And if I was, just imagine if in early January I said, hey, Conrad, like I'm going to the territories. I'm not going to have cell coverage. I'm going to be gone. I'm going to be doing something. I'm going to be back late May, right? I come back. I go, hey, Conrad, what the heck? Nothing's happened, right? Portfolio is basically where it was. Like anything going on?
Exactly.
And, exactly. And it happened.
Well,
it happened.
Yeah, it's all of a sudden nothing happened.
And then in 6 months, everybody bought the bottom, right? And then you'll hear the easy money's been made. And so, but the thing we need to look for is how this evolves. So let's say the Fed does cut, and they will be forced to cut. Then you have to revisit the demographic play in the United States, which would be home builders, right? Which we've talked about.
Yes,
right?
In which we've had that trade in there before and done quite well, both our DFR Horton as well as Lennar.
Right.
We know there's a structural shortage of homes, and you have millennials that are in their peak family formation years, peak spending years. These are important things to keep an eye on for sure.
And I think, but if you get back, so here's the thing and I'm going to hedge myself again, but look, the game in the energy patch just changed. If I'm right about Carney. And then what if the game changes, and what do we go back to, Conrad? We go back to taking our free cash flow and using it for exploration, not paying down debt, increasing dividend, buying back stock, right? And then what do these companies start to do? Because we know energy and mining is a tough business, right? They start destroying capital. What valuation do you put on the names of these companies if they go back to their old business model?
That's right. No, it's why we want to be cautious of them. I'm not saying that there's certainly something that I keep in my orbit. We have had oil and gas in the portfolio, as recently as a year ago. But again, that's exactly some of the concerns I have about, going back to, if the emphasis goes from shareholder return to production growth to get from that, as you say, from that 4 to 8 million, again, that changes the calculus, right? Because all that capital has to go into the ground. Because it is expensive to develop oil sands projects, which is really where the big production is going to have to come from because of the way in which our resources are set. So I think maybe on that note, Jim, I think we're reaching sort of the 45-minute mark, which is maybe the limit of the human attention span, and for some of us, certainly the limit of the human bladder. So what we'll do is I think we'll wrap things up here. I will just invite any clients that have questions from the things we discussed here today, just to send them to me. If there's something in particular that I'm unable to answer, of course, we'll run it by Jim and get the insight back to you. And again, if there's, as I always say, it's anything you need to discuss, whether it's about your personal situation, portfolio, or financial plan, please pick up the phone, give us a call. We're here to help and get the job done. So thank you, everybody, and hope you enjoy the rest of the days. Thank you.